And we are back, still talking banks with Ian Kagiri, who's an investment analyst at Cytonn. We're talking about coverage. George,
Absolutely.
you had a very important point on coverage.
Ian, I was saying that the way the coverage is calculated there is that banks only provide up to the extent where the collateral covers. And I was asking you before we went to break whether is this a loophole? And I know that IFRS 9 has also entrenched that now.
Yeah. And this is what CBK actually recommends, right?
Yeah, CBK usually say that, okay, fine, you only record in your books a first sale value of the asset. So if it's a building,
yes,
you ask yourself, how much can a buyer pay for this building today? X amount. That's what you put in as a coverage.
Okay.
So you own, if it covers 60% of the loan value, then you provide 40%.
Okay.
Ian, prudentially, do you think that's a weakness? In your assessment?
In a sense, yeah, it's a bit of a weakness because when it comes to actually realizing the value of this asset to cover for the
especially
loan,
buildings.
Especially buildings. It tends to be a tedious process. It creates that time gap whereby you may find the loan is insufficiently covered for. And it points to a point of concern, but however, I think this is in line with what's done even more globally.
Yeah.
So I think there's a bit of a compromise there because in line with accounting practices, you'll see that it's done globally, but still the coverage remains relatively low. If you look at, for instance, in a country like Nigeria, you'll find most Nigerian banks have coverages of above 100%, even if the loan is secured by a collateral.
So it's always over 100%.
Always over.
Is it a cultural thing?
I think it's a regulatory. It's more of a regulatory requirement.
It's more of a regulatory requirement.
Their central bank is very
The central bank is very stringent.
Yeah.
So then how do you capture that in your own valuation? And even more importantly, you've talked, I think I like the example you gave on asset values and talking about real estate. We had the discussion on real estate prices yesterday coming off. What does that mean for this coverage? So are they constantly going to be understated, and how do you capture that risk element in your valuation?
It's a very, and you're coming from a real estate company.
Yeah.
And what we're saying is that we've seen a situation where there's a disconnect between growth in house prices and rentals.
Yeah.
So there's a big rentals are not growing.
Not growing. Yeah.
House prices are growing. You end up with yields of below 5% on some of the high value properties.
True.
But the problem is that mismatch is reflected in most bank books.
Yeah.
How do you figure, and what Bide is asking is
how we capture that.
How do you capture
plug
that
in that in your
how do you
valuations?
capture that in your valuation matrix?
How much discount do you need?
And is it a material thing, or are we looking at the wrong lens?
It's a material thing because obviously a deteriorating asset quality eventually draws back on interest revenue.
Okay.
And the way we capture that is we tend to use a worst case approaches. We tend to assume worst case scenario.
Okay, so you're very bearish.
Yeah,
so your outlook on the sector, whatever that outlook is, which you will tell us in a few, is, if we understand where you're coming from, you are being very bearish, which is better to be bearish and see if there's actually any value if you apply the worst case scenario.
True.
Okay. Yeah. But then there's another element you brought before we go back to coverage. I think we've talked about a lot on coverage. What if we change gears slightly and talk about, you talked about the element of diversification and consolidation in the sector. Maybe it's worth just giving us a highlight on what you think is happening there and where the opportunities lie.
Diversification mostly has been beneficial to banks because it came in at the opportune moment, because it came in at the advent of the Banking Amendment Act that capped interest revenue. And so banks sought to mitigate those effects by venturing into the alternative income segment. And
which are?
So we've seen most of these being the transactional revenue they get from these alternative transactional channels. So the mobile banking, the internet banking, agency banking, bank assurance. So we've seen a lot of forays into those segments. But the one that comes to mind the most is, of course, the alternative transactional channels, the agency banking and the mobile banking, because you've seen a lot of forays by most of these large players to try and come up with mobile apps. Perhaps, I think, currently only one of the 11 listed banks does not have, you would say that is not as proactive.
Okay.
But they also, if you talk to management, but they also, it's also in the pipeline to launch some of these. So you'll see all of these banks have something to gain more transactional revenue from these alternative channels.
Okay.
Yeah, capitalization in the banking sector has been coming down since 2017.
Yeah.
2017 Q4, banking sector capital adequacy ratio was about 22%.
22%, yeah.
We are talking about 18%.
True.
Do you think it's an alarm bell for recapitalization? Do you think it makes sense to recapitalize?
I think the need to recapitalize would be more nuanced depending on the bank itself.
Yeah.
So those banks that are indeed operating at thin capital basis would be the ones that would need
to boost their balance
sheets.
And I'm asking you this because capital is coming down, capital levels are coming down, but banks are not aggressively lending. I would imagine a situation where loan books are growing 20% year on year.
And
that means they will have no room for business.
Yeah.
So do you think, I mean, yes, that's nuances, but broadly, capitalization is coming down in a situation where you're not lending. If the lending channel was to be opened up, you think there will be a mass recapitalization?
Maybe before you answer that, then could there also potentially be the element of NPLs eroding this loan books? Because NPLs have been growing from your analysis, yet your capitalization is being eroded. So what happens if NPLs continue? And if, for instance, as George is saying, the rate cap is repealed or it's reformed, and then there's an opportunity to lend, right?
Yeah. So the thing that has been actually depleting these capital bases is, if you look at most of these banks, and especially now you're looking at the entire sector, especially the tier 2s and the tier 3s, their capital bases have been the worst hit. And probably if you look at this, it's because the environment at which they've been operating in, it's become a bit tighter. If you look at most of these tier 2s and tier 3s, their top line revenue has been declining consistently since Q4 of 2016. So this consequently impacts on their capital base, because also if you compound that with the effect that the asset quality is deteriorating even further, so this continues to deplete their capital bases even more.
Okay.
And so, however, if you look at the large banks, you wouldn't see a significant shift in their capital basis.
They still have the headroom.
They still have the headroom to lend in the event.
So no expected dilution in the tier 1s? No
expected dilution in the tier 1s. In fact, what will happen is that in the scenario whereby the interest rate cap is repealed, some of these large banks have been holding a lot of liquidity in liquid government securities. So they are positioning themselves, they are pivot in the event of a repeal.
That's a very interesting observation, Ian, because over the since 2014, 2013, interest income from loans growing up, then the chart slams.
Yes.
Interest income from government securities has still a very strong upward movement. Do you think in a market where interest income from loans account for 70% of revenues, do you think this is sustainable? How long are they going to be buying government securities, Ian, before it busts?
They bust. Actually, I think from our observations, we've seen a recent upturn in increasing lending, especially towards the second half of 2018 and now the first quarter of 2019. Banks have noticed that given the declining yields on government securities, the interest income from that segment has declined. And they've sort of tried to increase their loan books, and they've been targeting specific segments. So they've been targeting the corporate segment. They've also been targeting the only secured lending and secured collateral-based lending, as well as working capital financing for some of these small businesses. So they're actually recognizing that it's unsustainable to consistently
keep buying debt,
keep buying government securities.
All right. Then maybe for the tier 2, is there then anybody we should be looking out for to expect them to come to the market and raise capital, maybe over the next 18 months?
At the moment, it would be difficult to tell for the tier 2s because the information is not public. However, what you can expect is that in the event that these companies want to recapitalize, the route that is likely to be used is that of the consolidation, as we alluded to earlier. So you're likely to see, if not an acquisition by some of these large banks, would be the formation of strategic partnerships among these small banks to try and
talking consolidation, we have CBA and NIC merger still in the process. We also have KCB, NBK, both. Well, it's those are two different stories. But I will ask you about CBA. It's all about balance sheet, strengthening that balance sheet. But this market is not balance sheet is not a value proposition in this market. What value uplift do you think is going to come out of that merger?
The main value
from what work, some of the work you've done on the merger.
our main value driver for that merger will be the digitization, because we do feel that CBA has a very, very strong digital brand, and we feel that if you look at both of the two banks, you'd see that NSA Group has this problem of mobilizing capital at expensive rates.
Yeah.
So you do feel that with the combination of with CBA, it may aid the combined entity to mobilize funds at cheaper prices, at cheaper rates. And furthermore, this will also improve on operational efficiency, because we do feel that most redundancies that exist would be removed. So,
so do you see a situation where the cost to income ratio comes to what, 40-30%?
40-30% is a bit too low. So we expect it to be 45 to 50 level.
Yeah. Okay, that's a good level. Yeah. But then also, if I can make my own contribution to this conversation, you know, if our economy needs to grow, think about it. The Treasury has to go out of the country to raise $2 billion. Today, the largest balance sheet that we have is about $5 to $6 billion, and that's up there, KCB. So if we need to actually drive a consolidation so that we can get to the point where our single obligor limits are actually way up there, where you can actually go to the government and say, Mr. CS Rotich, rather than going to the international markets, we can actually absorb. You need $2 billion. 2-3 Kenyan banks can give you $2 billion, and not, you know, and we can underwrite it instead of getting syndicated loans externally. So I think there's a way to go, and I'm happy with your observations, because this has been a conversation for the last decade, but now we're beginning to see it becoming a reality.
But aside from government, which is a very important point you're making, be there. Apart from government, do you see any sectors in the economy that will require larger balance sheets?
Any sectors that would require large balance sheets, probably in terms of companies that operate in this sector. Construction.
So real estate with the big four agenda.
Yeah, with the big four agenda, they would require big balance sheets to fund some of these large ticket mega projects. That is the most sector that comes to mind the most.
Construction of cities.
Oil and gas. We have oil in Turkana.
Yeah, but the oil and gas itself, a good
that
proposition.
Actually needs, if you're going to tap into that fuel in the next into that oil.
Talking about interest rate caps, the banking amendment, Treasury CS has proposed to repeal for the second time. So we know it's a purely political play, but in case MPs stick to their guns and say we are not doing all this thing, do you think banks are prepared to live with it? Have you seen any preparations?
Yeah, we've actually seen a lot of preparations. If you remember, there has been a lot of cost rationalization by these banks, staff layoffs, branch closures.
Is that really a very sustainable business?
I wish we could have this discussion. As usual, we're always running out of time. Ian must come back. But maybe what we can do, gentlemen, I think, because there's so many things that we are talking about here, but we must have on the top of our heads. When you look at the banking sector today, so for you in your report, what do you want to leave us with? What do you want to leave the investors who are watching us with? And I'd also like to hear the same conversation in terms of the summary from this discussion from George, and then we can be able to end our show and hopefully have you again on the...
For us, the thing we see from the banking sector, two things, growth and resilience. So in the face of tough economic periods, this sector has proven to be resilient, and we expect it to continue having this characteristic. So for investors, I think it presents
an opportunity to buy. Top picks?
Top picks, KCB Equity,
KCB
and
Equity.
DTB.
And DTB.
Yeah.
Brilliant. Thank you so much.
Thank you.
George.
Don't buy bank stocks. MPs are not going to budge.
So sell which stocks?
I'll sell all stocks.
Sell all stocks.
Yes.
So sell all banks, buy all banks. I think I'm with Ian on this one.
I like
buy
your
banks,
optimism.
KCB and equity. And you know why? When we think about it, long term, this country is going to be built on the foundation of banks. But this and more later on in the day. Remember to join us this evening on Markets Today, and that's 2:30 to 3:30. Thank you for joining us once again, and have a fantastic day ahead.